After a decade of being overshadowed by passive investing, hedge funds are showing signs of a renaissance. They outperformed in the fourth quarter of last year, provided better diversification than bonds, and now institutional sentiment is increasingly bullish. So, is smart money rediscovering active management? We're going to talk about that and more right now on UBS Trending. Hi, everyone, and thank you for joining me. I'm Anthony Pastore, and this is another episode of UBS Trending. Here in the studio with me today is hedge fund strategist from the Chief Investment Office here at UBS, Sean Sanborn. Sean, good to have you back with me.
Thank you for having me, Anthony.
Yeah, and it's really look, when we talk about hedge funds, we talk about alternative investments in general. It's a really interesting and very compelling story, but specifically with the hedge fund story, I wanted you to start off by just taking us through how they fared in 2024, and specifically how they performed relative to bonds and stocks, which we talk about on this show ad nauseum. So people are very familiar with how performance has been, especially with equities the last 2 years with 20% plus returns 2 years in a row. Bonds had a crazy year. How did hedge funds do?
Yeah, and thank you again for having me. It's definitely been a very strong year for hedge funds, but I think taking a step back and looking at kind of the broader context when you're talking about 2022, 2023, 2024, yes, equities have rallied, call it 65, 67, 70 plus % over the past 2 years, especially from the drawdown seen in the third quarter of 2022. Hedge funds have still fared very well, returning kind of around 35% during that same time frame from an equity drawdown, much higher than their overall long-term upside equity capture, and doing that with a very strong return, especially in the context of how bonds have performed, where they've been very choppy and muted, as well as the equity bond correlation has been kind of stable, unstable, and for the most part positive.
Yeah.
So hedge funds have been definitely giving you a larger bang for your buck, just not only from an absolute return perspective, but also from a diversification perspective compared to bonds. And then when kind of digging into overall kind of alpha, what we saw was pretty strong alpha just across the board from all main strategies. We saw very strong alpha from long-short equity, where shorting came back with a pretty strong vengeance. We saw strong alpha in both cyclical and defensive sectors, but we also saw very robust long alpha, where managers were largely kind of riding the AI theme and were overweight Magnificent Seven stocks for the majority of 2024. But we also did see from more less directional strategies, strong alpha within like relative value, where we saw kind of managers extracting carry and just kind of riding mark-to-market gains as spreads tightened in a classic bevy of relative value trades, call it fixed income relative value, convertible arbitrage, corporate credit, and structured credit. So really the whole bevy of fixed income relative
it's like
value
a full like Cheesecake Factory menu of options.
Right.
I wanted to just kind of, before we bury the lead, the outlook for CIO, which I know you'll get into, is remaining constructive on more uncorrelated and relative value strategies, but also you've gained conviction on some of the directional strategies like those long shorts you were talking about, some special situations. So now that we've got that out there, give us a little bit of a flavor of some of the risk taking that's happening across the strategies for 2025, especially if there's any noticeable trends that you've seen in the markets or anything that you're seeing at the moment within the hedge fund space.
I think kind of the main takeaway that we're seeing is really across the whole hedge fund spectrum, managers are largely fading beta in favor of alpha kind of in alternative risk premium exposures. So when we're looking at even at just the index level across kind of all the various HFRI index strategies, we're seeing much lower beta exposures than kind of their long-term historical averages. And this is also just kind of should be noted at the index level, where these are kind of probably over-diversified products, where each individual underlying category index has over 100 funds, and then the fund-weighted composite has over 1,000 funds. And when you're running a kind of some form of regression or any kind of analyzation of that return stream, you're kind of essentially diversifying away alpha in favor of beta. So when we're speaking with individual hedge fund managers or just doing some form of analysis at the median hedge fund level, we're seeing even lower level of beta exposures. Like in equity long short, we're seeing very almost close to historical highs from gross exposure levels, but then even nets are kind of closer to median exposures. And when you're beta adjusting those exposures, they're even lower. So we're seeing especially in the long short space, managers really kind of taking more kind of alpha oriented risk and looking at kind of maybe taking some higher quality or kind of growth at a reasonable price exposures.
Right.
And that's the case for most strategies as well. Within macro, we're seeing them tactically trading around equity, but for the most part, they're going into kind of more different areas, call it trading around currencies, riding kind of U.S. steepeners, and just outright front short U.S. bonds, and trading around kind of currencies, Japan, and EM exposures.
And managers were reducing risk in the back half or maybe the last 3 or 4 months of 2024 from what we could see as far as, when you look at what they're doing, and as you talked about in a recent report, kind of a function of locking in profits and deploying cash. So does that affect what we see today as what the expectation is for the rest of this year?
I mean, I think that's a function just of as how high uncertainty and dispersion and volatility is in the market. I think people, in relative value, definitely, we did see a lot of managers take profits, just lock in gains, and are more comfortable just sitting on higher cash balances, waiting for some level of dislocation. And that's really the main case for a lot of the overall kind of hedge fund strategies that we're seeing. It's just volatility is high, dispersion is high, and looking for any kind of short-term dislocations they can take advantage of.
Right. What about if you look at overall investor sentiment, especially from an institutional perspective? What were you seeing when it came to some of these surveys that were out about hedge fund and hedge fund investing in the markets overall?
Yeah, hedge funds may finally be back. It's interesting to say where kind of privates have definitely been the hot asset class in the alternatives landscape for a very long time.
For sure.
What we're seeing from institutional surveys now is hedge funds are on top of people's minds, even eclipsing private credit, where we've seen very strong inflows for the majority of 2024 and on. When looking at a lot of these surveys, call it probably half of institutional respondents are saying that they're planning to increase their overall allocations. Another quarter are keeping allocations stable or maybe looking for some shift in market dynamics to potentially allocate, and then only that kind of final quarter are looking to decrease their over allocations, and that's largely a function of specific funds kind of not reaching their expectations, as opposed to just an overall kind of negative view on asset class.
Right. It really does say a lot about the asset class itself that institutional investors are really putting their money to work in the space, and it kind of does throw away that, as we've been talking about for a while now, that traditional 60-40 equity to bond ratio for most portfolios, where you now allocate alternative investments, including hedge funds, in there. So let me just kind of then talk to you then and wrap it up about what the outlook is. Kind of gone into a little bit, and you did say there were like lots of gains and lots of success that was happening in the hedge fund space. Does it leave a lot of room for people to get in? Is it still a great investment opportunity as it sits today when we look at 2025, and especially with a lot of the unknowns that are happening with policy, with what the Fed will do? What are your thoughts on that?
I mean, it's hard, right? It's been 2 very strong years for hedge funds. And if you look at kind of the past 3 years, especially from a risk-adjusted return perspective, hedge funds have, even from just a strategy perspective, have beaten the lion's share of most passive assets. I think probably U.S. large cap's the only exception. But if you look at the structural tailwinds that hedge funds have had, kind of call it just higher rates leads to higher cash balances and better short rebates that you're getting from unlike long short books, as well as kind of just the overall market dynamics. We expect these to increase in 2025 and in some instances, or stay the same in 2025 and in some instances even intensify. Like you mentioned, I mean, we have a new presidential administration coming in where it seems like there's just ever-changing rhetoric and just overall implementation on tariffs, fiscal policy, and just immigration policy. You have diverging monetary policies as well as especially in the U.S., stickier and more stubborn inflation, and there's kind of been an extension or a pause on the overall kind of Fed rate cuts. You have very elevated equity valuations, and I'd call it top quartile to even top decile historical and uneven bond yields. These should all be factors that hedge funds should be able to take advantage of. And what we've seen is higher overall uncertainty, higher dispersion, higher volatility. We expect that to even ratchet up further.
Right. It seems like they're able, that managers, hedge fund managers, are able to deploy risk right now in the environment that we're sitting in.
They are. We've seen that so far in January, like for instance, where we've seen discretionary macro managers that have largely kind of been taking advantage of a lot of this macroeconomic volatility, moving into kind of different currency exposures, moving into less loved areas like European equities. We're seeing different kind of event-driven strategies, taking advantage of just the robust restructuring opportunity that we're seeing. But we're also still seeing like certain strategies that are kind of waiting for increases in volumes like merger arbitrage. There's definitely been an increase in overall kind of corporate sentiment and on kind of potential M&A activity, but it still hasn't necessarily come to the foreground. So people are more just largely kind of happy, at least in that space, just holding on to kind of current risk and putting in a higher potential deals.
Right.
And just holding on to cash.
Yeah, I mean, it's exciting. It's a really active market, and there's a lot going on. And obviously, we're telling our clients and advisors, diversified portfolios, especially in this environment where there are a lot of unknowns ahead of us, is really the right formula. So including hedge funds and privates in there as part of an allocation is certainly really helpful in that full diversification kind of look when you're looking at a portfolio. Diversification is key. So thank you, Sean. It's great to have you join us. I think there's going to be a lot that's happening within this particular space for the rest of the year, so I'm sure we'll have you back. Thanks for joining me.
Thank you for having me.
Good to see you. Sean Sanborn, again, from the Chief Investment Office. And for more information on anything that Sean and I talked about today or anything else coming out of our Chief Investment Office, visit our Insights website at ubs.com/views. Plus, you can also follow UBS on social media. We're on all the channels like LinkedIn, Facebook, and X. Plus, you can follow UBS Trending at our Instagram page at UBS Trending is the handle there. And as always, if you have any questions about what Sean and I spoke about today, make sure you are chatting with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody.